Are you wondering about what's going on in the real estate market these days? Well, you've come to the right place. Today, I'm going to take a look beyond some of the recent headlines to give you a little perspective about what's happening when you take a step back and look at the big picture. I love the saying that the headlines do more to terrify than clarify. And I'm going to look at a couple of recent pieces of news and give you some data that'll give you a little different way of looking at things, so you can look beyond the clickbait and make a decision about what it all really means to you. So we'll start out with a tweet from Diana Olick and the CNBC article. And what this says, what the headline says, is that homeowners have lost $1.5 trillion in equity since May as home prices drop. And that is indeed correct. But let's kind of take a step back and look at the bigger picture and look at some sort of more long-term data so you can get a little perspective on that. Here's a slide that shows what's happened to tappable equity. And tappable equity is the equity that people have in their house that they could borrow, which would keep them below the 80% loan-to-value ratio. So as you can see what's happened, this graph goes back to 2005. You can see what happened during the Great Recession, and that slowly but surely things have moved up. And then, boom, the past couple of years, they've really jumped up a lot. So there's been a little clawback because the temperature of the market has changed. But people still, if you go back 2 years from here to here, that is a big increase by historic standards. Here's a quote from First American. Homeowners have a very high level of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. So people have a lot of equity. If somebody runs into trouble, which people will, it happens, and certainly the economy is experiencing some signs of stress and distress. And so when people run into trouble, homeowners run into trouble, most of them have enough equity that they could sell their house, pay all the selling costs, and still have money in their pocket, which certainly was not the case back in 7, 8, 9, and 10. Here's another headline from CNBC. Household debt soars at the fastest pace in 15 years as credit card use surges. And this is data from the Federal Reserve. So it's real live data. So now let's take a look at the information. Let's take a step back and look at it from a slightly different, more long-term perspective. Here's a chart that shows what's happened to credit card balances since Q3 of 2019. You can see back then they were 32, 41, 91. And so then they took a big dip down. And so this was partly because people were staying home during the pandemic and they weren't spending money. They weren't traveling. They weren't going to restaurants, all that kind of stuff. And there was a lot of stimulus money floating around. And now you can see that the balances have started to work their way back up because people are out and about and they're spending money. And so from here to here is that big scary number that the headline talked about. But if you look from here to there, we're basically back where we were. Here's a quote from a recent blog post from Liberty Street Economics. Though delinquency rates are rising, they remain low by historical standards and suggest that consumers are managing their finances through this period of increasing prices. Again, it's been a tough time, no question. But if you take a little step back and you look at more of a historical perspective, you can see that things are about back to where they were in 2019. Now let's take a quick look at some information about mortgage debt, because that's certainly, for most people, that's the biggest debt that they have, that homeowners, that's the biggest debt that they have. So this is a chart that shows the historic mortgage debt to income ratio back to 1980. And you can see where it was in the housing bubble. It was 7.2 7.21%, and that for the period between 1980 and the bubble, it was, sort of largely in the 5 to 6% range. And here we are today. Granted, it was down there before, but we're still very low, not a little over half where we were back during the Great Recession or the real estate bubble. And here's a quote from the Mortgage Bankers Association. For the second quarter in a row, the mortgage delinquency rate fell to the lowest level since they've been doing their survey back in 1979, down to 3.45%. Foreclosure starts and loans in the process of foreclosure also dropped in the third quarter to levels further below their historical averages. All right, so here you can see a chart that shows you what's happened with foreclosures for about the past 20 years. You can see where they were in 03, 04, then they started to ramp up. You hit the top in 2009, then they started to taper off, and for a good chunk of the past 10 years, these are the levels that they've been at. Then 2020, 2021, you had forbearance and you had the moratorium on foreclosures, so they went artificially low. Now they're started back up, so there's a big jump from there to there, but still, again, by historical standards, if you take this line and you go straight across, it's not even close to where it is in normal years. So there you go. Little bit of information, mostly national stats. Usually I do local stuff, but every once in a while I like to take a step back and kind of look at the big picture, both broad and also looking backwards. I hope you found it useful. If you would like any information about what's going on in the local market, happy to help. My contact information is below. If you'd like to see a recent market update that I did for Montgomery County, you can click over here. And if you'd like to subscribe to my channel so you'll get updates whenever they come out, click over there. Thanks for watching, and I'll see you on the next one.